What's going on, traders? Welcome to another Tackle Trading webinar. This is Coach Tyler Craig, just jazzed to be here. We're going to talk about long call options tonight. Teach about the leverage and limited liability associated with this particular option strategy. I'm not talking to anybody. I'm going to take off this headset. We're going to buckle down, have a nice little conversation. If any of you are joining us for the first time, welcome aboard. We are Tackle Trading. We teach people how to trade and invest. We educate and entertain surrounding all things in the financial markets. Tonight's conversation is going to give you a little taste of some of the content and education that we provide on our website, tackletrading.com. Real quick, Tanyan, if you have anything for me, because I took my headset off, throw it in the chat window for me as we go. Cool. Otherwise, I will assume we are good to go. So I'm going to be a little bit on a PowerPoint tonight and a little bit on a Word doc as I take a few notes, a little bit on a blackboard as maybe we draw out a few pictures to help us better understand buying call options and how to manage those trades. I've already introduced myself, but if you want to see the bio slide, I am, again, Tyler Craig, one of the coaches at Tackle Trading. I'm also a CMT, a chartered market technician, so I love me some charts and looking at indicators and different technical analysis concepts. And I built a couple of systems for Tackle Trading, cash flow condors and the bear market survival guide. Also, I host a couple of blogs over there. So you should come check it out. I'm going to jump into the long calls in just a second, but I do want to bring to your attention, it's the holidays. Black Friday has come and gone. Christmas is coming up, and we slashed the price of everything at Tackle Trading. Everything's on sale. Go over to the store tab at tackletrading.com. You can use this little link here, bit.ly/tackle holiday. We got a lot of products, a lot of stuff to help educate you. If you know what you want, go jump into the store and grab it while it's hot. If you don't know what you want, if you need some help putting together maybe a more personalized package, if you want to sit down with a coach and say, hey, here's where I'm trying to go, help me understand what webinars or what systems might be appropriate to me, you can schedule a consultation. tackletrading.com/schedule-consultation. Finally, maybe you want a free trial. You want to check it out, take it for a test drive, risk-free. We got a way to do that as well. You can get a free pro membership for a couple of weeks to give us a trial. bit.ly/join Tackle Pro is the link. All right. That's out of the way. Let's get down to business. What are we going to learn in today's webinar? I'm going to teach you how to find long call candidates. How do I find a good stock to buy a call option on? I've got a couple of core criteria that I think you'll like. How do I pick the right strike price and expiration? There's a lot to choose from, lots of different strikes, lots of different expiration months. How do you narrow it down? Sometimes it can get confusing as to the bounty of options, of choices that you have in the options market. I'm going to give you some guidelines on that. And then how do you manage the position once you're in? Where do you put your profit target? Where do you put your stop loss? How do you know when to get out? We'll dive into that in detail as well. Okay, so we'll probably go, I don't know, 45 minutes or so tonight. I'll try to make it as enlightening and entertaining as possible as we go here, but maybe shooting for around 45 minutes. We'll see. We'll see how long-winded I get, but I want to do some examples on my trading platform as well, and bridge the gap between the theory and the application, and actually show you how to get it done. So, lest you don't know much about the options market, maybe you're brand new. Let me bring you up to speed on what a call option is before we jump into buying a call option. So, got my little stylus here. We'll take maybe a few notes. Let's start with maybe the most fundamental question. What the heck is an option contract? We're not buying stock here. We're using the derivatives market to build a trade around a stock using an options contract. By definition, this is what an option is. It's a contract between a buyer and a seller that gives the purchaser of the option the right, but not the obligation. They don't have to if they don't want to buy or sell a specific stock at a specific price on or before a specific date. Now, at first blush, it's like, man, there's a lot to unpack there. Well, when it comes to call options, here's kind of the nuts and bolts. Okay, here's the nuts and bolts. You don't have to memorize this. You should eventually if you're going to trade options, but that's the base definition. So let's isolate the call option for a second because that's what's commanding our attention today. For a call option, think about what do you do when you want to make a phone call? You pick up the phone. You pick up the phone to make a call. So when you hear the word call, you need to associate that in your head with up. We buy call options on things we think are going to go up in value. Call options make money if the stock goes up in value because they give you the right to buy the stock. It's green. Green we associate with up or bullish. That also helps kind of reinforce it in your mind. So it's the right to buy stock. When you buy a call option, you've locked in the right to buy stock at a set price on or before a set date. Okay. And so what we're going to get into today is knowing really just the keys here. Like what do I buy a call option on? Okay. Should I buy it on Apple stock? Right? Should I buy it on Apple? Should I buy it on Tesla? Like, what am I buying a call option on? And then when do I do it? When do I pull the trigger? Okay. And then how do I manage? How do I manage the trade? How manage? That's good English. How manage? How do you manage the trade? I'm going to give some general guidelines, some best practices to get your feet wet, get the ball rolling, and teach you how I like to use call options. When I'm feeling a little, I don't know, when I'm feeling good. Buying call options is an aggressive trade, so you don't do it when you're just kind of like have a whatever opinion. You usually got a strong opinion when you buy a call option. Because it's got a lot of leverage. You can make money quickly when you buy a call option. Now, I introduced the idea of leverage, or at least I used the term. But let me unbutton that or unpack it a little bit for you. The idea of leverage, just so we're clear as to why call options give you leverage. Basically, when you buy a call option on a stock, the stock might go up, I don't know, 5%. And at the same time, the call option might go up 50%. So do you see how a small move in the stock yielded or translated into a big move in the call option? That's the idea with leverage. It amplifies the return. Okay. So one of the reasons why people like call options is because if they go buy one on Apple or Tesla or some other stock, and they're right, and the stock goes up 2, 3, 4, 5, 7, 10%, the call option will do that and more. You get amplified returns. And so speculators who look for these tactical opportunities to get bullish on a stock can amplify their return using a call option. Okay. What about the limited liability? This is the other. I've got that. I'm rolling with the L's today. The limited liability. I can spell this. I know I can do it. There we go. Limited liability. What does that mean? Well, the other kind of key advantage of a call option is they're cheap. They don't cost as much. They don't cost as much as buying stock. And so your risk is what you pay. And because you're paying not as much money, you're not risking as much money. And so you can build call option trades for, $100 or $200 or $300. And so they're cheaper trades versus maybe putting thousands of dollars into the stock. So I can tie up less money and have amplified upside, more levered upside with this type of instrument. Those are some of the reasons why you might want to spend a few minutes learning how to do this, right? Okay. So let's get back to this what. So what do I buy a call option on? Let me give you some best practices, some guidelines maybe for finding candidates. For finding candidates. I got a Word doc here somewhere. Let's discard that. Let's go to my Word doc. Oh, there we go. Okay. So how to find candidates. Well, number one, got to be a bullish stock. Got to be a bullish stock. We're big fans of technical analysis. We also like fundamental analysis here at Tackle Trading. But, listen, from a timing perspective, technical analysis gives you better timing tools than fundamental analysis generally. And so if I got to find something that's going to go up over the next couple of days or couple of weeks or couple of months, I think the tools that are going to best enable me to do that are charting tools, looking at the trend, looking at support levels, looking at price patterns, all the things that fall under the umbrella of technical analysis. So whatever way in which you discover bullish opportunities, those tools you're going to use for long calls. Okay. So for me, I'm a pattern guy. I like to find specific chart patterns. And my two favorite chart patterns are bullish retracements, essentially buying a dip in an uptrend. You know, when you get a nice uptrend that's making higher highs and higher lows and higher highs and higher lows, and she's stair-stepping higher, and it just made a higher high, and then the stock pulls back 3 to 5 days, and it's sitting at support. You're just licking your chops here. Oh, I got a nice buy the dip opportunity in this stock. Well, when you see that, a long call could be one strategy you use to capitalize. Okay. So a bullish retracement pattern, another pattern that I like on the chart. I'll show you some examples here in a second. How about a bullish breakout? This would be buying an uptrend as it's blasting through maybe a key ceiling or resistance level. So in technical analysis, we believe that stock prices move between support and resistance levels. And forget belief, it's a fact. That's what stock prices do. And oftentimes when they break through a ceiling, a resistance zone, they see upside follow through, right? And so I want to be on the lookout for good bullish breakout patterns as well. So how do you do that? Well, listen, I have a watch list. And this is a Thinkorswim trading platform. Lots of good charting platforms out there, but I'm going to illustrate off of Thinkorswim here. And I've got a watch list. It's my liquid stock watch list, and it's chock full of, I don't know, 150 liquid stocks, popular companies you've heard of. And one of the things that I do every week, usually on a Friday to prep for the next week or over the weekend, is I just go through these guys, one chart at a time. And I look for those patterns manually. Trains my eyes, right? And I can go through quite a few charts in a short period of time. I go through until I find a pattern that I might like. For instance, I'm in alphabetical order here, and I've come across American Eagle Outfitters. It's a retail stock, clothing company. And recently, this entered an uptrend. And that uptrend actually had some pretty good momentum off of the earnings announcement. Okay. And since that, since the big jump here, the increase in momentum, it's gone sideways for about a week. On Friday, it had a bullish engulfing candle. And today, despite a broad market that was horrific, stock market was terrible too. It was garbage. AEO closed in the green. You know how few stocks closed green today? Very few. This thing's flexing. Okay. Look at me, you bozos, you red stocks that can't stay up. I closed 0.5% higher. Chef's kiss. Like, come on, that's pretty impressive. This is a bullish breakout. You see how it's formed resistance at $16 for the last 5, 6, 7 days? Bullish engulfing on Friday, and then boom, right today, trying to break out here. That chart looks pretty good, right? From a pattern perspective, that's what I like to see when I'm considering a long call option, okay? The other thing that I really like for a long call option would be a cheap stock price. a cheap or cheaper stock price. Okay. If we were looking at something like, and I know I'm jumping around here, but I'll come back to my stock picking in a second. If I looked at something like Deere, Deere was another one I came across over the weekend that's got a nice uptrend and is basing sideways at resistance. But it's $450. I mean, call options on this, certainly buying a call on Deere is going to be cheaper than buying the stock, but it's still going to be kind of expensive because it's $400. I mean, call options might cost me $1,000 on Deere, a couple $1,000. So the price range of the stock. So going back, the American Eagle Outfitter is at a $16 price tag. A long call would be a very easy trade to build on this because it's going to be quite cheap. Like I'm talking like $100, maybe even $80. I'm going to be able to get it cheap. So cheap stock, good price pattern. So going back, how do I find a good chart? Well, again, manually go through my watch list. Okay, maybe you use scanning tools. Do you know what I really like? What I really like is every weekend, pulling up a web browser here, going to go to Tackle Trading. Every weekend, the coaches at Tackle Trading scan hundreds, thousands of stocks and try to find clean patterns. Those are our scouting reports. One of the things you get when you're a pro member are weekly picks, right? We do the dirty work for you. Say, listen, I don't have the time to go through hundreds of charts, thousands of charts, and find setups like AEO, which are nice little bull breakouts. I want you to do it for me. You do all the work, and then you narrow it down and you give me the top 10 or something, right? So if you go to Tackle Trading and you go to the reports, and this being an options discussion, I want stocks that could be good candidates for options. So I go to the December 2nd options report and I scroll down, boom, bull list, 10 stocks. Okay, 10 stocks. And you know what? AEO is not on the options report, but it is on the stock report. Okay, you would find it on the stock report this last weekend because I had a good setup. Right? So I'll come to here and I'm like, hey, you know what? I didn't have time to scan. So let's see what the coaches brought up. They gave me some good candidates this week. I like the scouting report as a shortcut. Okay. So again, Tyler uses his own watch list and his 2 eyeballs to find quality setups in cheap stocks. And he cheats and uses the scouting reports. All right, work smarter, not harder, right? That's what I do with the scouting reports. Work smarter, not harder. So in those scouting reports, I might favor, see, I got one right here. I go to personal, boom, scouting report, bulls from December 2nd. And you'll find right there, top of the list, AEO. AEO was one of them. Another one was Delta Airlines. Delta Airlines was another one that made the cut because it's got this uptrend over the last couple of months, and it was poised to break out. In fact, it did break out today. It just picked a bad day to try to break out because the broad market was garbage today. S&P gapped down and sold down like 2%. Just selling off all day long. Gross. So Delta Airlines was up a lot this morning and then got dragged down with everything else. It's actually back to its breakout area, which makes me think it's interesting. Okay, I think Delta Airlines is still in play here as a long call candidate. Only $35 stock too. Good pattern, good price. 2 good characteristics. I'm going to give you a third characteristic here. Third characteristic on finding candidates for a long call option. Okay, we'll put this number 4. Low implied volatility. Low implied volatility. What do we mean there? Well, this is a little bit more advanced, but one of the things that you'll learn with option values, just as stock prices go up and down and they get expensive and cheaper and expensive and cheaper, the cost of call options fluctuates. Sometimes call options get cheap. Sometimes they get expensive. And to look at the price tag of an option, you look at implied volatility. So I've got a little indicator known as implied volatility rank, or IV rank, and it tells me where implied volatility currently is relative to its 1-year range. Like, is it in the lower end of the range? Is it in the upper end of the range? Where is it at? And if it's in the lower end of the range, it'll be like in the lower quartile, right? So if you look at like 1-year range, 100 would be the top end, 0 would be the low end. And if you're below 50, you're in the lower half. And if you're below 25, you're in the lower quartile, right? So for instance, you look at Delta Airlines, look at the implied volatility rank. It's at the 12th percentile. And you can see it visually too. You see how the line is down at the bottom, right? Delta Airline options are cheap. They're cheap. So I not only like Delta Airlines because it has a pretty pattern breakout and it has a low price, $35, which translates into lower cost options. But by themselves, options empirically are cheap as well. Okay. Boom. What's not to like? Listen, if you like calls, this checks all the boxes. This checks all the boxes. Can I add a fifth just because? It's also easier. I get the warm fuzzies buying calls if the S&P 500 is in an uptrend. I mean, if there's one kind of buzzkill to buying call options in 2022, it's just simply been that we've been locked in a bear market, and that when you look big picture, the market backdrop has not been all that helpful when you look overall. Okay. I mean, if you're a newcomer to the financial markets, 2022 has not been a walk in the park. It's been one of the not one of this is the longest that we've spent with the S&P 500 below the 200-day moving average since the subprime mortgage meltdown in 2008. 2008, that was like 14 years ago. Okay, so 2008 until this year, we had never gone down and stayed down as long as we have this year. Okay, so it's been a bearish backdrop, and we've had a few moments of glory where the stock market's come up for air a little bit, but they've been few and far between. For instance, July to August in the S&P 500, we had a good little 2-month uptrend there. And you know what? In fairness, we've had a pretty good little move since October, right? I mean, here's the trend of the S&P 500, and bulls have gotten some traction. Not today, those losers. Massive rug pull today in the market, but you take a step back and you say, yeah, it's still overall kind of moving in the right direction. That's true. That's true. So you kind of have to be the judge as to how picky you are. Will you buy a call option if the S&P is kind of or will you wait for it to look really, really good to be in alignment with the individual stocks you're trading? You got to decide that, but that would certainly help as well. You go back to 2021 when the S&P was in a nice uptrend. You had a lot more success with long call options. So keep that in mind as well. Keep that in mind as well. Okay, enough on how to find candidates, I think. Those are my top 4 or 5 criteria. Got to move on to the next one. I found a candidate, and I'm going to say AEO and Delta Airlines. Those are my two ideas. Those are my 2 ideas using those criteria. So all right, let's build a trade on one or both. Okay. So I'm gonna come in now and think about, well, which call option do I purchase? Because unlike stock, where there's only one American Eagle Outfitters ticker symbol, there's AEO. Everybody on the planet who wants to trade or buy American Eagle, that's trading the underlying, as we say, the stock. There's only one choice: AEO. Buy the stock. If I go to the trade tab and I look at what we call the option chain, look at all these choices. Oh, it's like I'm at the Cheesecake Factory with their phone book of a menu, right? It's like, well, I mean, gee, mini Christmas, give me 45 minutes to look through this thing and I'll let you know what I want to order here. This is a lot of choices. They have options on American Eagle that expire anywhere from 4 days from now. You can buy a call option that expires in 4 days. Or you can go all the way out and buy one that expires in 774 days. I mean, that's a lot of choices, right? So you probably want to have a guideline to narrow down your time frame. And ultimately, so the month selection is a function of how long you're going to be in the trade. Why in the world would you buy 700 days of time if you're trying to swing trade American Eagle and you're just trying to be in and out of this thing in a week? You don't need to pay all the extra money you're going to have to pay to buy 2 years of time. So what is your time frame? My assumption, if you're swing trading, is your time frame is a couple of weeks, tops. Okay. And I also point out that in a bull market, when prices are rising and you want to give the stock time to do its thing, you're probably more inclined to buy a little bit more time, buy out a couple of months, just in case it keeps rising and allows you to better maximize the gain. In a bear market like this year, it's been a guerrilla tactic type market where you gotta get in, you gotta get out, you gotta take your money when you got it, and that probably means that listen, I'm bullish on American Eagle for the next week or two, a month out, 2 months out. Have you seen the market the last year? I have no idea that far out. So I'm probably going to shorten the time horizon in this current market. So normally on a swing trade, I'd say go buy a couple of months out. Okay. For our purposes today, I'm going to shrink that and maybe just buy the front month. Certainly not going to buy December monthly because that expires in 11 days. I'm thinking January. Okay. 46 days out. I think that's enough. I'm going to go to January options. I see call options on the left here. So even though I've narrowed it down to January 20th, okay, I still have a gajillion different call options to choose from. Okay. So without getting too deep in the weeds with all the nuances with buying way in the money versus out of the money and everything, let me just cut to the chase and tell you, I like the idea of you buy 2+ months in a bull market. If it's a quick trade, maybe you're buying 1+ month. Okay. And then when it comes to strike selection, usually I buy maybe one strike in the money or maybe an at the money call option. And that's just fancy speak for if the stock's at $16, 1608 in this case, I'm going to buy essentially the at the money, which incidentally, it's also in the money by 8 cents, would be the 16 strike. Okay. So I'm going to buy the 16 strike, maybe the 15 strike. That's the first or second strike in the money. Okay. What I'm not going to do is buy way out of the money because those are lottery tickets. Take my word for it. You buy way out of the money. It's a lotto ticket. It's dirt cheap, but that's because there's very little chance you're going to make any money. And I also don't think I need to buy deep in the money, like buying a 10 call on a $16 stock, because those are unnecessarily expensive. So sweet spot's going to be right around the current stock price. You feel free to express opinions on whether it's 1, 2, 3 strikes in the money, maybe at the money, maybe the first strike out of the money. There's some minor differences there. For today, I'm going to assume we're just going to go first strike in the money. Pretty good rule of thumb. In this case, that's the 16 strike. Now, to buy it, you click on the ask price. This is trading for $1.16 by $1.22. Option Basics tells you that one contract controls 100 shares of stock by default. When we say it costs you $1.22, that's per share. You got to times that by 100, and it's $122. So this call option is going to cost me about $122. Now, you don't have to buy it at the ask price. You actually are usually able to split the bid-ask spread here. So I'm going to click on the ask. It defaults to $1.22, but it tells me that the middle of the bid-ask is $1.19. I think I could get it for about $1.19. $119. Not that expensive. Limited liability. And if American Eagle stock goes up 5, 10, 15%, I think I'm going to get multiples of that with this call option because of the leverage. So in sum, American Eagle Outfitters, bullish breakout. Tyler found it with his eyeballs by looking at his liquid stock watch list. He also found it on the scouting report. Those clever coaches, those savvy sleuths, those, I don't know what else to say. Those gracious gentlemen and gentlewomen who do all the hard work for me. put AEO on my radar. I found that it had a nice little bull breakout, and it was a cheap stock, and it had relatively cheap options because of the low implied volatility. All signs pointed towards something like a long call, So I went in. I bought a January 46-day, one strike in the money call option. That's the trade. Now, maybe this works, maybe it doesn't. Okay. I mean, I've done everything I'm in control of, but there aren't any guarantees here. Maybe AEO goes to the moon, maybe it implodes. So I need to map out my management. That's the third piece. Trade management. So, two parts. What do you do if you're right? What do you do if you're wrong? In other words, profit target. What do you do if you're right? And like stop loss. What do you do if you're wrong? Well, let's start with the optimism. Glass half full here. I mean, I'm probably going to be right because I'm feeling good about life, okay? What's my profit target? Well, you could use the pattern to guide you. I mean, listen, what does technical analysis teach you about projecting where a stock could go after it breaks resistance? I mean, oftentimes we look back to the left and we say, well, there's a ceiling at $16. If it breaks that ceiling, where's the next ceiling? Where's the next area of supply? Where's the next price zone where sellers have come in? And you'll see on the way down here, American Eagle had a lot of support resistance levels along the way. And this right here was a down gap that then saw resistance around 16 bucks. Okay. If I break above 16, I think this could fill the gap, which takes it up to about 17. And then the next pivot is about 18 bucks. I think ultimately the 18 bucks is a fair target on this. Okay. And I don't just think that. The coaches, which are so generous in giving potential target ideas, if I go look at the stock report, because that's the one that AEO is on, I'm going to find, I can't remember if it was target 1 or 2, because we usually give a couple of targets, like a short-term target and then maybe a longer-term target. I go down, 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 and I see AEO, bada bing, bada boom, target 1, 18 bucks right there. So 18 was the first target. I'll go with that. 18 bucks. That's the target. So you could let the chart guide you, use the pattern to guide you. That's kind of a clunky way of saying it. How about just the next resistance zone? Okay, for AEO, that was 18 bucks. Do you know what else you could do if you're going for like a quick target? Is maybe you could go for a 1 ATR. 1 ATR profit. ATR stands for average true range. It's the typical candle size. So on a daily chart, it's about how much you move each day. AEO is moving about 84 cents a day. I have it at the top of my chart by default, 84 cents. So that would put it up towards about 17 bucks as a 1 ATR profit. So if you want to like really guerrilla tactic, go in there and take the money and run, okay, maybe in a day or two, 1 ATR would be a viable short-term target. Okay. Those would be my two. And do you know what I really like is I like the idea of scaling out. Sometimes we make life harder than it has to be as traders. We're like, listen, the way to make money is buy the low and sell the high every time. It's like, you're never going to do that, dude. I mean, you're good, but you're not that good. Okay. Give yourself a break. Don't make it so hard. You're not going to be perfect in the timing here. And so why don't you give yourself multiple chances of getting out at the right time? Like, why don't you take partial profits when you get a quick profit, take some off the table. You've locked in some gains. You've kind of scratched the itch of hey, locking in some gains. Okay. But then you've also allowed yourself to make more money if it keeps going. Okay. So those all or nothing decisions, should I get all out or stay all in? Well, I don't want to get all out and then it keeps going up without me. And I don't want to stay all in because what if it goes back down and I give back what money I've already made? Well, compromise, scaling out, take partial profits. It's a great emotional compromise between staying all in and getting all out. So listen, maybe we peel off, maybe we buy 2 call options on AEO. Maybe we buy two contracts. And I take off one if this gets up to 17 bucks, take a quick profit, and then I'll let the other one ride till we get to 18 or maybe 19 and go for a bigger profit. Then I've had my cake and I've eaten it too. Right. So I really like the idea of scaling out as a better way of maximizing the gain and giving the stock a chance. Now, you could preset that if you wanted to set up the order. So some people would be like, all right, let's do first triggers all. Let's create an opposite order. I bought 2 of them. I want to sell one if the stock goes up to 17 bucks. And I could sell the call at market, and I could go click on the cogwheel, and I could put in the stock price. I could say, listen, if AEO gets at or above 17 bucks, ring the register, take profits on the first one, get the heck out of Dodge. There's lots of different ways of doing the order entry. And I don't want to spend 45 minutes teaching you 10 different ways of building orders. This is just one. But conceptually, it takes some off if it hits 17, maybe. Right? All right. Enough on the target. Let's mop up here with the stop loss, and I think we got a pretty good plan going. So what if I'm wrong? Heaven forbid. I'm afraid to even acknowledge that that's a possibility. I could be wrong. Okay, maybe American Eagle is, maybe this breakout's doomed to fail. It's going to go up just enough to get Tyler in because he's a schmuck, and then it's going to implode. So possible, anything's possible. Got a plan for that. That's what a good little trader does. He anticipates the good, he anticipates the bad, and he maps out a plan of how to handle it. I don't know what the market's going to do. I do know, and I should know what I'm going to do, how I'm going to respond, right? I don't want to be a victim who's always reacting. I want to be proactive and anticipate and map out my moves ahead of time, okay? So number one, this is part of the beauty of the limited liability part of a call option. Listen, how much money did I put up? Put up 119 bucks. Now, if I bought 2 contracts, I put up 240 bucks, essentially. Okay. But for simplicity, let's go back and assume I bought 120 bucks. American Eagle could implode. It could go to 0 tomorrow, and I would only lose 120 bucks. 120 bucks. So I mean, listen, you may not even need a stop loss. You could risk what you paid. If you can afford to lose the call value, you don't need a stop loss. Lucky you built a trade that was so cheap that you could just give it plenty of room. You got 46 days. You can let AEO shake and bake all at once, bob and weave, up and down, chop, 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 doesn't matter. Not going to shake me out. And then hopefully by expiration, it moves in the right direction. And if it doesn't, if we drop and we're below 16 and the call is out of the money, it'll go to 0 and you'll lose your 120 bucks. Now you may say, well, I get it. I could risk what I paid, but I find that unnecessary. I don't know that I need to give it that much room. I don't know that I need to lose the entire 120 bucks. Okay, well, listen, how about you use technical analysis? Maybe we exit if the stock breaks support and invalidates the pattern or reason that the pattern that got me in. This is very common technique. If you go look at the chart of American Eagle, what is the premise here? What was the whole rationale for entering? Why did you like it in the first place? Because it was a nice uptrend, because it was sitting at resistance at 16 bucks, because it had this nice little high base that found support at the 9. Okay, great. How do you know when you're wrong? Aren't you wrong? Isn't this high base pattern invalidated if we break $15 support? You know, if this thing goes down, 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 and then breaks 15 bucks, breaks this support zone, that is a failure of the high base pattern, right? Bulls defended 15 bucks on Friday. They're sitting at that 9 EMA, gobbling up any shares available. If they're gonzo, next time we go down to 15 and there's no support there and we break it, and this thing could fall quite a ways before the next support level comes into play. And so you might reason, hey, if we break 15, I'm out of here. All right, well, then use that. Is it 15? Yeah, 15 bucks essentially. So we can put a stop loss there. And you're not going to lose the whole 120 bucks. So this is where a risk graph comes into play. A risk graph gives you a picture of the position and allows you to see how much you're going to make or lose if the stock moves to a certain price. So I'm going to analyze the Jan 16 call, and I'm going to go down. This is the current stock price. I'm going to go down to $15. And it tells me right there, if it drops to 15, like pretty quick, you're going to be out about 50, 55 bucks. Okay, well, that's about 40% of the entire risk. Better to lose 55 than lose 120, I suppose. So with a stop loss, I can reduce that risk. I can limit the liability even further than the 119 that was the risk from the get-go, right? And I can put in an order for that. I can say, listen, let's do first triggers OCO. I got my entry at 16. I got my exit at 17. And then if I'm wrong, I want to sell the call if it breaks 15 bucks. So I'll go click on the cog wheel and I'll tie it to the stock price. This is a conditional order. It says if American Eagle gets at or below 15, that's my support level. I'm out. Sell the call at market. Get me out of here. Because the reason that I entered is no longer valid. The high base pattern that had so much promise has failed. Thus, I exit. That would be an example of putting in the entry to get in. Right now, I'm assuming that tomorrow morning at the open, I mean, if the market gaps down and this looks terrible, never mind. But assuming this holds the breakout and continues to look promising tomorrow morning, this is buying the call at the current price. I'm presetting a target. I'm presetting a stop loss. This would really be me putting in what's sometimes called a bracket order to map out the whole trade, my entry and both of my exits. So you could take the same thing I just did on American Eagle, this nice little high base breakout, and you can apply that to any similar situation where you're bullish, where the stock's relatively cheap, at least cheap enough to make long calls viable. That's going to be helped by having low implied volatility, which reflects that option values are low or cheap, right? And then you can map it out. Delta Airlines was the other one that I think also qualifies as a breakout. Again, today's candle makes it a little messy, but I do still like where it's at. It's cheap stock, cheap options, similar type of rationale for why we like it and where the stop might be. But it's another one where a long call could be a viable option for somebody who's aggressive. Admittedly, the fascinating thing about the options market and buying call options it is that call options are like the first strategy you learn. Just the simplest way of using an option contract. Buy a call instead of buying stock. But incidentally, maybe there's another term I want to use there. I don't know if now let's just say it's the simplest strategy. Everybody starts with a long call, but ironically, it's also the most aggressive. It's also the most aggressive strategy you could do. Feast or famine. If you're right, you make money very quickly. If you're wrong, it's quite unforgiving. So for instance, if I go back to that American Eagle example here, with this, if the stock goes up to $18, which ultimately I think was our target, like the main target, right? American Eagle up to the next resistance at 18 bucks. Now I don't think it's going to get there like immediately. I think it would take a little bit of time. But if it got up to 18 bucks, I mean, you're talking about a profit that's essentially double what you put in. You're putting in 119 bucks. If it got to $18 anytime soon, you're making about 120 bucks. You're doubling your money. How much did the stock go up again? Stock's going up $2. $2 rise in the stock. Where's my calculator? Get over it. There. $2 rise in a $16 stock. 12.5%. American Eagle going up 12.5%. And then the call option going up 100%. There's the leverage component. Stock up 12.5, call up potentially 100%. That's if it works, of course. Maybe it doesn't. But the point is, it amplifies the upside. Okay. And then this is it's like a gateway drug. Okay. Once you learn how to buy a call option and you're rolling and you're implementing these techniques that I taught, you're going to quickly discover, yeah, that's right. I'm on like the ultimate aggressive end of using options. Maybe you want to dial it back a little bit. Maybe you want to be a little less aggressive. Maybe you want to increase your probability of profit by making the call option or by morphing it into some kind of spread trade. And then you'll start to learn how to do spreads and everything. And it's just a wonderful, wonderful world of options trading. Long call, the gateway, the intro, the easiest way to learn the dynamics of option contracts, how they work. But again, it's a gateway. There's a lot of other really fun ways that you can use options to further enhance your risk, your reward, the way you structure your position. That's a great stopping point. I think that's a great stopping point. We're right around the 45 minutes that I said I think would be my target in time. I hope that you found this enlightening. Hope that you found this a good introduction into what a call option is, how it might work, how you might build the trade. We got plenty more. Let me pull these up. In fact, let me show you the tackle store here. Let me show you the tackle store. Okay. Somebody just ran through the store and they just started marking stuff off. Oh, let's make that cheaper. Oh, let's throw that on sale. Let's throw that on sale. Let's make that cheaper and that cheaper and that cheaper. They just slashed the price of everything for the holiday season because we appreciate you guys and we want it to be as easy a decision as possible to invest in yourself and invest in education and improve your understanding of how the markets work and how to make money and how to manage your portfolios and such. So you go to the store tab, you go through there, all sorts of sales that you can check out, getting access to the types of content that Sami introduced to you tonight. Okay. I hope you've learned something in the last 45 minutes. That type of commentary, trade ideas, management ideas, is just a taste, we got one-on-one coaching. If you want more, one-on-one attention versus in a group setting, we got pretty much anything you need. Okay. Pretty much anything you need. No shortage of options, or ask a coach for some consulting and say, hey, talk me through an educational package. It might be appropriate for me. And you can get more on that, but appreciate you guys for coming out today. Always a pleasure. More webinars to come, and we'll see you in the next webinar. Have a good night.